UK Tax Podcast, UK Corporate Tax Residence, with John Kavanagh.
Welcome back to the UK Tax Podcast. My name is John Kavanagh and I am a chartered tax advisor with my own private practice. I mainly advise other professional advisors, but also private and business clients. I've been working in tax for 40 years and have been a chartered tax advisor for well over 30 years, so I hope this podcast will offer something useful. Today I want to talk about corporate tax residence in the UK. This is an area that has been the subject of significant scrutiny by HMRC in recent years, particularly in view of international tax avoidance concerns, and arguing that an offshore incorporated company is in fact UK resident is often HMRC's first line of attack where international structures are concerned. The UK applies a two-pronged test for corporate residence. The first is simple. If a company is incorporated in the UK, it is automatically tax resident here unless it falls within an applicable treaty tiebreaker. The second test is more subjective and potentially more complex. If a company is centrally managed and controlled in the UK, it is also treated as tax resident here, even if it is incorporated elsewhere. This test, which derives from case law rather than statute, looks at where the highest level of strategic decision-making takes place. In the past, that has often meant looking at where the board meets and makes key decisions. However, HMRC's approach has evolved over time, and in some cases it has argued that the real decision-making power lies elsewhere, for example, with a parent company, a dominant individual, or even key employees acting on instructions. This approach has led to some complex and contentious disputes. A recent illustration of the issues surrounding corporate tax residence has emerged in media reports about Roman Abramovich's offshore investment companies. Investigative journalists have suggested that some of these entities, registered in jurisdictions like the British Virgin Islands, may have been effectively managed from the UK by his associates. If this were the case, it would certainly raise questions about whether these companies should be considered UK tax residents under the central management and control test, potentially leading to significant UK tax liabilities. It will probably come as no surprise that, while the British Virgin Islands does have a tax treaty with the UK, it does not address corporate tax residence or include any tiebreaker test. When a company is considered tax resident in both the UK and another country, the provisions of a double tax treaty will usually apply. Most UK treaties follow the OECD Model Convention, which historically used the place of effective management as the tiebreaker. In simple terms, this meant looking at where key management and commercial decisions were made. However, in more recent treaties, and under the OECD's current approach, the test is often replaced by a requirement for the competent authorities of the two countries to come to a mutual agreement on residence. Notable examples include treaties with the United States, Canada, Japan, and Germany. This can be an unpredictable and time-consuming process, leaving companies in limbo and creating uncertainty about their tax obligations. One of the issues that arises in international tax planning is that not all jurisdictions take the same approach to corporate residence for tax purposes. Some countries determine residence solely by reference to where a company is incorporated, without considering where management decisions are made. Bermuda, for example, only treats incorporated entities as tax resident and does not apply any management and control test. Historically, Ireland had a similar rule, which led to tax planning structures where companies were incorporated in Ireland but managed elsewhere, avoiding tax residence in any jurisdiction. However, international pressure has forced Ireland to amend its rules to include a management and control test, removing this loophole. HMRC's approach to corporate residence has arguably become increasingly aggressive, particularly in cases where companies have sought to limit their UK tax exposure by holding board meetings overseas. HMRC often argues that the real decision-making still takes place in the UK, undermining the effectiveness of such arrangements. Unfortunately, the central management and control test is not always applied consistently by HMRC. In some cases, they will argue that a board's decisions are ineffective because they are in fact controlled by someone outside the boardroom. In others, it will argue that day-to-day operational control is enough to establish residence, even if strategic decisions are genuinely taken elsewhere. The subjectivity of the test obviously creates a compliance risk for some companies, as what might appear to be a valid offshore structure can sometimes be challenged subsequently. There are also wider concerns about the uncertainty created by the UK's reliance on a case law-based test rather than a clearer statutory definition. Countries that apply a simple incorporation test at least provide certainty, whether one agrees with that approach or not. The UK, by contrast, leaves companies in a position where their residence can be challenged based on subjective interpretations of board minutes, emails, and informal discussions. While the intention is to prevent tax avoidance, this uncertainty can sometimes inhibit genuine commercial operations from structuring themselves efficiently. Of course, even where a company is not resident in the UK or in another jurisdiction, it may still have tax liabilities if it has a permanent establishment there. I do not intend to go into this in detail here, but a permanent establishment generally means having a fixed place of business through which a company's business is wholly or partly carried on. In most cases, this means having a branch, an office, or a similar physical presence. However, under some treaties and domestic tax rules, whether est by statute or by case law, having employees or agents in a country who regularly conclude contracts on behalf of the company can also create a permanent establishment. The OECD's base erosion and profit shifting (BEPS) reforms have tightened the definition in many treaties, making it harder for companies to avoid a taxable presence simply by fragmenting their operations. For companies operating internationally, this is a critical issue. A non-UK company with UK customers may not be tax resident in the UK, but if it has employees in the UK negotiating contracts or a UK office handling customer relations, it could have a permanent establishment and therefore a UK corporation tax liability on what are arguably its UK source profits. Similarly, a UK company expanding abroad must consider whether its overseas activities could create a taxable presence in that country. In some cases, this might be beneficial, for example if the overseas jurisdiction has a lower corporate tax rate, but in others it could lead to possibly unexpected compliance obligations or disputes over profit attribution. Her Majesty's Revenue and Customs has become increasingly focused on permanent establishments, particularly in relation to multinational groups. It has challenged businesses that rely on commissionaire or agent structures, arguing that these create a taxable presence even when the formal legal arrangements suggest otherwise. The UK has also introduced the diverted profits tax, which applies a penal tax rate, where HMRC considers that arrangements have been put in place to artificially avoid a UK permanent establishment. This is another example of the UK's arguably increasingly aggressive approach to taxing international businesses, and while it is aimed at large multinationals, the principles can affect smaller businesses with cross-border operations. I'm John Kavanagh, and I'd like to thank you for listening to this episode of the UK Tax Podcast. More episodes are on the way, and I very much hope you will join me again for the next and future episodes.